very familiar with Wyckoff, it's an opportunity to give you guys an introduction into where Wyckoff started and sort of the world of Wyckoff. Okay, so that's what I'm going to do now. So in order to do that, we're going to take a look at primary market phases. Now, an accumulation phase. Now, this is when large institutional interests, or what we like to call the smart money, decide to buy an instrument. Okay, so for guys who are familiar with like the books, say, from Jesse Livermore, Edwin Lefebvre's account of Jesse Livermore, right? You would hear him talk a lot about like pools and operators and composite. The composite man is what Wyckoff refers to them as, right? So when we're talking about the composite man, we're talking about the guys who step into the asset and control it. So you're going to find that there are a lot of composite men. There pretty much is a composite man in every single stock, right? No matter how many stocks are out there, there's a guy who controls it, or there's a pool of guys who control it, which essentially means that that stock moves up and down based on what they want it to do, right? So it's their general idea. So that's what we mean by when we say that an accumulation phase is when a large institutional interest or smart money, which is kind of the term that gets bandied about a bit, but they're not really smart, they're just large. Right? But if we say like smart money for the sake of saying smart money, okay, they decide to buy an instrument. And that eventually leads to what we call a markup phase, or a sustained rise in price as a result of the increased demand. Now, the reason this happens is very simply is that demand overwhelms supply, right? So it's the basic principles of demand and supply, right? And then we get what we call the distribution phase. Okay, so that's the liquidation or selling of an instrument by large institutions. Okay, so in effect, those same guys, right, who bought this asset, right, who accumulated it in the beginning, and now deciding to get out of it, and they need people to sell it to, right? It's really important, and you'll discover this through trading, that there are always pigs in the market, and everyone wants the other person to be a pig so they can get the benefit of it. So it's not it's not a very kind of moral environment, okay? But the truth of the matter is that there is always someone to sell to, right? So this is the distribution phase. So it's when these large interests start selling out. And what you will discover as you learn about demand and supply is that in order to create demand, we have to do what we call advertising, right? It's basic principles again into marketing as well. So you advertise. And how do we advertise? We advertise price. Okay, so we advertise price and people see the price and they get excited. How do we reach that audience? We go through cable networks or financial news channels, and we advertise to the audience about specific assets, specific stocks. We get them riled up. We get them really excited about being in the markets, right? And that's how we create the demand, all right? And this all takes place in the distribution phase, and you will see the relevance of this as we start when we start looking at the technical charts. And then that looks at the markdown phase. Okay, so that's a rapid decline in price due to excess supply. So in the distribution phase, supply overwhelms demand. Okay, and that leads to a markdown. Okay, so prices fall quite rapidly, right? And this is not an instant process. And distribution phases can last months, it can last days, it can last weeks, it can last years. Okay, so it's a long process. Depending on how much of the asset was accumulated, how much of it they now have to unload at higher prices will in effect determine the length of time that we spend in either distribution or accumulation, depending. All right, so this is a conception of primary market phases. So this is a basic chart of what actually happens here, right? And then we get the accumulation, the market. We're going to talk a bit about reaccumulation and redistribution at later points, but I don't want us to focus on this heavily because this is going to be when we talk about it, when we go through our technical charts. We're going to spend a lot of time with this because technically this will help us or allow us to get a grip onto understanding when we should think of something as accumulation or when we shouldn't, right? So this will be like more like we'll discuss this when we get to real life charts. All right, so let's look at Richard Wyckoff, right? So the guy that we're talking about, this course is largely built around his ideas, his principles from a practical perspective. I haven't changed anything. I've just harnessed the information, really looked at it. I've really traded it, and I've really got an understanding of modern markets today as it relates to Richard Wyckoff back then. I mean, at the end of the day, if we're not making improvements as traders, if we're not being able to see the changes, then we're good as dead, right? So changes are important. So law of supply and demand, where there's an excess amount of something, right, i.e. supply, the value of that item is reduced, or there's a scarcity of something, then the value of that item will increase to create the supply that will meet that demand. It's pretty simple, right? This is basic economics. So for guys who are already familiar with economics, will be familiar with the law of supply and demand, right? And Wyckoff goes further to talk about the law of cause and effect, right? So we all seen the matrix, causality, right? I always like a reference in the French guy, right? One thing leads to the next, right? So cause and effect, right? In order for there to be an effect, i.e. a change in price, there needs to be a cause, right? There's got to be a reason for that to happen, right? So when you think about the large interests, when they buy up all those assets, they got to give a reason for the price to go up, and that can only happen if there's sufficient demand or there's sufficient supply in the case of the price going down. Now the effect will be in direct proportion to that cause. So the best price moves occur when there's been enough time to allow for a period of accumulation or distribution, or in other words, the cause. And this is what's gone wrong for trading. In fact, in my opinion, for a lot of people who've especially started in the Forex environment, what they've found is that because of the way Forex works, there is not sufficient time to allow for a decent enough cause. So you tend to get very erratic and sporadic price movement, and that causes people to lose a lot of money, especially the Forex market is quite highly leveraged. And this course works very well for Forex as well as for the stock market. Okay, so and also for commodities. So this is more a holistic approach. So it doesn't matter what you're trading right now, this should be useful to you, right? So time is a crucial factor here. We have to allow for enough time, in other words, that cause to develop before we actually pull that trigger. Right, and then we have the law of effort versus result. Now, so simply stated, if there's an effort, the result must be in proportion to that effort and cannot be separated from it. So we've got to see the activity. We've got to, in other words, see the volume behind it. Okay, so if there's nothing going on there, and you'll see when we start discussing on the technical charts, the importance of looking at this specific thing, effort versus result. And if there's not enough effort, the results won't be equal. So if we start seeing exponential results versus very little effort, then we have to be a little bit concerned. Okay, so this is what we call anomalies, but we're not going to get into that right now. So if it is not, it is an indication of other principles in action. Now think of the effort as the volume on a move, and the result is the corresponding price action. Now these two should be in harmony. Okay, so they got to go together. This is so important, right? Without that effort, we shouldn't see any results, right? And if we start seeing a huge amount of effort with very little result, also that's something we got to be concerned about. Right, so this is what Wyckoffian logic actually looks like when we somewhat break it down, right? So we can actually say here that all these different points that we're going to discuss actually in a little bit more detail, but this is like an overall view, and this line down here is like sort of the volume display that you will normally see on your charts. And the importance of volume and the use of that within Wyckoffian logic is really, really important. You'll find that a lot of sort of trainers or educators on the web talking about volume sort of exclusively, and whilst that's all good, but we have to be able to put that in the context of price action, right? So we see a lot of this going on, and just to let you know that a lot of the volume stuff is actually ripped directly from Wyckoff, right? Wyckoff is such an old it's such an old concept. I mean, this is going back to the late 19th century here, early 20th century. So it's very old. So a lot of it has been ripped directly from Wyckoff and then applied in isolation. And that's why sometimes we don't get the full picture. All right, so here we can take a look at what we call the accumulation phase. Right, so we're going to discuss on the technical charts phase A, B, C, D, and E. Now, what's most important to remember is that this is progressing through time. So this is very much a cyclical approach to trading, right, rather than a linear approach. What you'll find is that a lot of strategies are very linear. So one thing has to happen for another thing to happen. Whilst you look at strategies like Wyckoff, Elliott wave, these strategies are largely cyclical, which means that everything is happening within a given point of time at the same time. Okay, so different things are happening, and it's not a linear type knock-on effect. Okay, so what we witness in here in a phase A is when the market is declining and we hit that bottom and we get a selling climax, which then results in the price reversing quite violently. And that in effect sets what we call the trading range. Okay, so the AR dictates the trading range, right? So once we see the AR, we have a very good idea of where the trading range is. Now, when you start looking at charts, you'll find that this is actually it's a representation, but when you look at the charts, it doesn't always look like this, which means that you have to use your brain. You've got to think about what you're seeing. And I'll show you how to do that when we get to that point, right? So we got the selling climax here. So this is the markdown phase. This is what we call the preliminary support. So that's the point where we hit and we form a preliminary support, but then we break that, and that normally sends all the traders going south as well. So everyone starts shorting the move at this point, right? But then we hit a selling climax where all that supply gets absorbed, and then we get a reversal, and then the market gets tempered into a range as the accumulation process begins. So that's phase A, is like the start of it. Phase B is when we do all the testing, when we shake out all the traders that we don't want. We check to see if there's demand, if this market is ready to run. Because the thing you'd find is that if, as a large trader, if you make that market move, right, and it starts to push and you can't get the demand to push it, you need everything to get that price up, then what you'd find is that you're going to get hit by supply later on. So what you want to check is to check out and make sure that you can grab the best prices on the test, and then make sure that there's no supply trying to hold you down. So that takes us through these different phases, okay, and we'll discuss them a little bit more in detail. And then obviously we have, in some cases, a terminal shakeout, or we just get a secondary test and then we launch off and we start seeing signs of strengths and obviously last points of support, etc., and jumping over the creek, right? So we will look at this in more detail, but this is an example obviously of an accumulation phase, right? And then the next example we're going to take a look at is an example of the distribution phase, right? So again, similar situation, but we have obviously, as opposed to getting a spring or terminal shakeout, we have an upthrust after distribution and a terminal upthrust. Right, so we're going to look at these as well in a little bit more detail as we progress. So again, just be patient. We have an ice, right? So once we start breaking that ice, we start seeing the distribution hold. So this is the overall description of distribution. Right, so that ends this particular section of the course as an introduction to Wyckoff, and as we move into the second section of the course, or the second module, we'll start to look at things in a little bit more detail and start to break down via charts some of that accumulation in real time. Looking at part two, where we discuss the basic structure using various different time frames, asset classes, to understand how Wyckoff works in real time. All right, so we're actually looking at an asset right now, and this is dollar yen on a 15-minute chart. Okay, so this is a currency. Again, for guys who are familiar with FX, you'll immediately start to enjoy this and get to grips with it. On the same side of the fence, if you are more of a stock trader, and bearing in mind that this specific course has actually been done with stocks in mind as well, and also commodity traders who are not using market profile, right? And again, guys, if you want to learn about market profile and you're hearing this for the first time, we have a course on market profile, which is time price opportunity, so check it out. And we also have a course on Elliott wave as well, so and that actually marries in very nicely with Wyckoff logic. So again, and when you see me work with giving you some practical examples of managing your trades, then you would actually understand what I mean in terms of Elliott waves relevance to Wyckoff logic. And what you'd find is actually these people, they existed within the same sort of timelines. Now, Elliott was more the early 1920s to the 1930s, and Wyckoff was more the early 1900s. Rather, and the late 1800s. So very close in timelines, but the reality is that most of these guys are within the same period. So you find that ideas and strategies are relatively very, very close, and some of them have better ways of doing things than others, and it's nice to be able to take that on board. Now, there's no right or wrong in investing. It's about having a strategy that works in terms of how you manage your positions, and you'll be able to handle your risk from a very comfortable, relaxed perspective. And that's what we try and do here, is try and get you into that place where you're relaxed and you can handle your investments and you're very confident about it, right? So we're going to talk through the different structures, right? And then we're going to go a little bit more in depth in terms of analyzing the accumulation area, right? So the basic structure is we have accumulation, right, which is, from this perspective, I'm on a 15-minute chart. It looks quite small. If I was to put this in a 1-minute chart, you'll be able to see more tests, etc. But what we've got here is our climax point, and this is our secondary test, and this is our LPS, or last point of support, and that makes up the accumulation area, and then we take off into the markup phase. So most traders who are already familiar with Wyckoff would have already identified this as a very good trading opportunity within a 50-minute time frame, considering we had been distributing prior, so this is not really that complicated or difficult to get your head around, right? And again, we'll talk about the finer points as to how you identify this as accumulation. And then we break into a markup, and then we start to distribute. Okay, as you can see, there was a distribution, and then that's went into what we call a re-accumulation. Now, it doesn't always look like that. What you'd find is that some people prefer to teach it as accumulation, markup, re-accumulation, then distribution. But like I said, that's a linear way of looking at things, and a lot of people are linear. It's partly due to our Western education systems, which have taught us in a very linear fashion. We've been taught that one thing leads to the next, right? And as a result, we need to see a step-by-step approach. Now, I'm sure all of you have heard people use the term step-by-step approach, right? They do not like words like dynamic approach, because dynamic feels like I'm so confused. I want a simple step-by-step approach. The fact of the matter is that there is no simple step-by-step approach. What we have is a dynamic approach to trading and investing, which means that you are going to have to be dynamic and think a lot more about what's going on around you, and expect that multiple things are happening at multiple times. Now, bearing in mind that the whole world are not 15-minute traders, okay? There are traders who are trading on 4-hour charts, 1-hour charts, 1 day, 1 year, and we do not know when they're going to act. They might be acting right now in very large quantities. So the reality is that whatever algorithm is now making the market has to respond to all these different participants at these different times, but all happening at the same time, right? So what we have is a scenario where we've got accumulation, markup, distribution, and that was fine for 15 minutes, and this is an actual distribution. But then a larger player steps in, right, that is now willing to take us into a next stage of markup. A reaccumulation begins. It's very quick, it's very rapid within the 15-minute, and we get a much larger markup cycle. Now, if I was to push this into, say, a 30-minute or 1-hour chart, then what you will see is a lot of this finer detail will disappear, and then we'll be referencing a much larger move. And an Elliott wave practitioner, for example, might observe this as an ABC cycle, right? Or some other kind of trader might look at this as an AB equals CD type cycle. So the truth of the matter is that we are technically seeing relatively the same thing, but our observation is very different in terms of what we're using to determine what action we take, right? So the truth of the matter is that we do not get a smooth cycle of accumulation, markup, reaccumulation, and distribution and redistribution. What we get is a cycle where we go accumulation, markup, and distribution within one time frame, and then all of a sudden another time frame steps in and controls the market, and then recreates a reaccumulation just slightly under that distribution, and then we go into a new markup phase, and then we start to distribute again. Now, depending on whether this distribution is going to be a more long-term distribution or more long-term cause, then we might see this market dropping way back down again into the reaccumulation or accumulation zone. So this is obviously now looking ahead at the future. This is a live market. It's a live 15-minute market, but we don't know what's going to happen. So we have to act on our market based on these principles. So as we drive in, right, we start to make different observations as the price action develops. So this is actually distribution, but then on the flip side, this might build up into a larger form of accumulation moving forward on a higher time frame. So it's just being aware that the markets are not linear. They are cyclical in nature, and they operate in a very dynamic fashion, which means they operate on different time frames at different points in time. Okay, so it is not a simple arena, and if we try and oversimplify it, beyond a shadow of a doubt, we're going to make a few mistakes. Right, so this is one example of the basic structure. Now let's take a look at an example coming from the top down, just reflecting that cyclical nature. So this is British pound sterling on a weekly time frame. So as you can see here, we have a type of upward distribution that was taking place, and that eventually led to a markdown and a redistribution, which actually lasted 5 years and then continued to redistribute. So within this redistribution, there would have been accumulation phases as well as distribution phases as the market develops, and then eventually we came down. But if we looked at it on a longer time cycle, we would have realized that we were actually in a redistribution phase. And I'll tell you why you would consider this a redistribution phase, and this will take you a little bit into Elliott wave. And it's a very, very good guide when you actually start physically trading with Wyckoff, to use that as a marker. So if you, well, and we'll discuss this in a little bit more detail as we get into another course, so another part of the course. So in effect, that's what we're looking at. And I guess now, looking at this, it makes sense to everybody why we're seeing pound sterling rising right now as we entered the final markdown, which took us back to 2016, right? So for most people, it's not strange to see the pound rising, and I have no doubt in my mind that we will eventually develop a trading range, and we will start building on pound sterling. And since this is happening in a much larger cycle, we can actually go into a much smaller cycle to visualize the behavior of pound sterling. So you can see here distribution, markdown, redistribution, and final markdown. So again, this is just another another sequence in the cycle, and that I didn't show you guys in dollar yen because that was actually absent. But as you can see, this has taken a slightly more linear approach over the longer term. But again, we must not get into the habit of thinking the market is linear. So we've seen here distribution, markdown, redistribution, and final markdown. This is very linear. So one thing has led to the next. But in most cases, if we looked at pound sterling over maybe a 5 or 10 year cycle, then it might show you a completely different picture, right? So it's just something worth bearing in mind, that there are things happening over different time frames. So we should try and abandon that mentality that everything is linear, right? So hopefully this you've enjoyed this section of the course as well, because I wanted to give you guys an overview of what it looks like on a chart, because when we often talk about these things, we don't exactly get to see them on a chart, because you know, yeah, it's all good. You know, when you have to act on this stuff, it's a little bit different, right? And being able to understand the differences, the dynamic differences between the fact that we get a linear setup like this, which is what you will get taught because it's a perfect setup, but also be able to visualize what was happening at these different points in time, because this is not quite a straight trading range. What we have is just restricted topward price action, but this is all distribution, and you will see me explain that in the other sections of the course. Again, this is a much smoother trading range, right? So this is more flat and horizontal trading range, and we have nice redistribution, and we have a nice sail under the ice into the final markdown, and this is picture perfect, right? But then when we go to look at our dollar yen example, far from picture perfect, because what we have here is overlapping time frame activity. So we have accumulation, markup, distribution, which seems perfect without the reaccumulation, redistribution in the middle, and then we start to reaccumulate at a lower base, right? And this is very, very strange, because you know, you'd easily want to regard this as a new accumulation, but the fact is it is a reaccumulation, because we're still above the overall accumulation area, and that puts us into a stepward action into a new markup phase. So you can actually identify that there are unique differences between these two modes of operation. Awesome stuff. Hi guys, on this module I'm going to talk to you guys, or explain to you guys in very vivid detail what the difference is between what happens in an accumulation phase and what happens in a distribution phase. So we're actually going to look at inside accumulation. Okay, so we're going to look right now in this module inside accumulation. So I'm going to show you guys the different phases that happen and how we can identify them in real time. What are some of the nuances, how we can work around this, and everything is labeled pre-hand just to make it short. I would have liked to have done this dynamically. I'm very much a dynamic person, but I couldn't for time reasons. I want this course to be short, engaging, and I didn't want it to be long and drawn out, because that will mean that everyone gets bored and they start going and then that's not great, right? So as a result, I've decided to kind of pre-label everything, and then we can talk about it individually. So I hope you guys appreciate that, and I'm not really copying out of anything. It's just that it makes life a lot easier for you and for me too, right? So I'm actually going to start looking at INVA, right? So this is a stock, right? So it was great for me to move away from the currency, right, which Forex guys have absolutely loved if you've been just watching the other videos, but just to show you how it works it's the same in every market. Okay, so it's not really different. And INVA is a great stock. This is a stock that I purchased in the past, right? And it's a stock I'm looking to purchase again, right? I'm just not ready for it right now, right? And when we look at the PCOM example, Points.com International was a great trade that I called a couple of actually going back, I think it's almost about a year ago, and it was a great addition to my portfolio, and PCOM has done fantastic. And you'll actually have a look at PCOM and see how it's doing currently relative to its prior lows, right? So these are actual stocks that I on my watch list and I have traded in the past. Okay, so I'm giving you a very good example right now on how you could work with these stocks. And some of my other great buys over the years have been Take Two Interactive, and if you guys have any chance, just pick up a chart of TTWO. I purchased this at $9 a share and traded this to the immense highs at the time of about $30 a share, and then I repurchased it at $30 a share and took it to the highs of about $70 to $80 a share, where I couldn't do it anymore, right? So but if you look at TTW, it's done phenomenally well over the years, right? So that's just an example of some of the investments that I've done, and my primary resource for doing that has been Richard Wyckoff, especially when I've been dealing with the stock market. So it's really great to have a stock example. Right, so let's take a look at INVA. Right, so this is typically what happens in accumulation. So the asset has been distributional, it's been marked down for a fair amount of time, and we hit what we call a climax. Now, it's very easy to identify a climax. Now, and I say easy because most of the time you will be able to identify it. Now, the tricky bit is that the times when we get a climax and there's something missing in that climax, and that takes us back to the Wyckoffan three laws. Right, so let's have a look at INVA. So we've been distributing and then we hit the climax here. And how do we identify a climax? Well, that's by high volume. So you can see there's a climax, there's high volume. This is an amazing climax. It's great. Usually when I see climaxes like this, my blood boils. I really get excited. Right? Reason being is that I know that this is a trade that I want to do. The time is always near. Now, talking about some of those nuances, what I always like to do is respect Elliott wave theory. So I always try and establish very, very quickly a 5-wave count just to make sure that I'm actually seeing the climax. Now, a climax comes 80 to 90% of the time after a third wave. So just really grabbing on this here, right? And don't mind where my zero is right now. It's going to look maybe a little crazy, but it's okay. So I'm just going to put things just so I can get this out of the way, right? And I know we're coming in all wave 5. So this is like a really good benchmark for me, so I don't get the climax wrong, because it's very easy to see the climax. I could buy the stock at $7, right? $7.33 or where's this actually? Give it a proper line. $7.54. And then say, well, I'm running this, I'm expecting the AR anyway, so I'm just going to buy it at $7.54. But I'll be ignoring the fact that there's probably a greater opportunity for it to come where I can buy that stock at $4.50, right? So why would I want to take it at $7? I mean, you know, for $4.50, there is no way I don't make money from that stock. I'm doubling my money. I'm definitely doubling my money, right? No question about it. So I like to add a little bit of Elliott in there to spice things up. Try and establish a 1, 2, 3, 4, 5-wave count over. If you see a nice clean distribution like this, try and establish that, because it will probably alert you as to where the spring is going to be, which is our next subject. And that's normally the end of wave 5. So again, I'm going to come off Elliott now. I don't want to we do have a course on Elliott wave, so I don't necessarily want to merge this in Elliott. I want to talk specifically about Wyckoffan logic. So what you can see here is that as we hit the climax, we did an AR. Now the AR for me forms the trading range. Now you would notice that some people might say that, well, you get the AR, you're going to get a secondary test, which is going to extend the automatic reversal range. So your trading range would have sat at 1487. But for me, as good practice, I keep the trading range at 1377, because 8 out of 10 times that trading range will be very difficult to beat. So if you want to be a swing trader, right, and you want to maybe just play inside of the accumulation, maybe you want to do a couple of shorts knowing that you're going to get at least 2 secondary tests before this market actually breaks out of the trading range, then you want to put that into perspective, right? So the first phase, right, of accumulation, so that's phase A, right? So remember, markets are not linear, okay? That's all I'm going to keep saying. Markets are not linear, right? So the first part of accumulation is phase A, right? So phase A is where we get the climax and the automatic reversal. That's phase A, because that starts to define the trading range. And actually, if you look at Facebook, right now, Facebook established its trading range. Now, anyone who bought Facebook as it crashed into the lows of $150 a share, well, it's actually now $165 a share. So, okay, so you're making 15 points right now on Facebook, right? And that was a trade that I actually did. And it's not because I want to really carry Facebook now out of the accumulation, but I think for a large cap stock that just got hit by that S&P 500 decline, it was a great time to get involved. All right, so that's just a brief example there of something that I'm not seeing right now, but I actually remember, and you guys can take a look and just see how Facebook developed into its AR and essentially hit that spring. All right, so what we got here is that automatic reversal, and then now we get a pushback where we break the climax low and we do what we call a spring. Now, usually the spring, there's no demand, right? So generally when we get a spring, it's kind of a false action and it acts like a shakeout, right? So normally if you're long here, you panic, you might let the position go on the spring, right? And then it comes back and then you're wishing that you didn't let that position go, right? But the spring is what you want to look out for. So if I see a climax, my next stop is to look for a spring, right? The moment I get a spring, it doesn't matter where I'm buying within that spring. And that's the beauty about it, is that you don't have to rush to buy the stock. You can just calm down and see the spring and then pick it up when we start seeing some more buying just after the spring. So I would have been a happy buy at $5.20 all the way into $6 a share. It would be awesome for me. I would have been gladly buy INVA, okay, in Aviva. So it would have been an amazing buy. Right, so that is one thing you got to bear in mind, is look out for the spring, right? And that's, the spring is the beginning of phase B. So your stock is not going to run away. And this is normally the most tumultuous time for traders, because if you look at, we're looking at a weekly of INVA. It took basically from 2008, right, when we established the spring in November. The phase B itself didn't actually end till 2009 December. So it was like a whole year in phase B, and phase B tends to be the longest, right, when we look at it inside accumulation. So most people would have been happy buyers in '08, and they would have cashed out about $13 a share. So you can cash out in the accumulation if you don't have a long-term horizon. But the most important thing is that regardless what your trading time frame is, markets are not linear, right? So no matter what your trading time frame is, right, you would have an opportunity to buy it at those lows and sell it back in the accumulation, because even though this is part of a wider trading range, it is still accumulation. It's still, there is another cycle within it, basically. So it's accumulation, but it is also markup in another cycle, and it's also distribution in another cycle. Okay, so just bear this in mind. Markets are not linear, right? One thing doesn't lead to the next, right? So going forward, the spring showed up very low volume, right, which tells me that the market has been completely shaken out. There will not be a TSO, or what we call a terminal shakeout, in the future, which normally occurs around about phase C, but or the end of phase B, but there will not be a TSO. Normally people look for a TSO, so you'll see people teach and say buy the TSO, but most of the time the spring is the best to buy, because these days the spring normally is cleaned up everybody, so there's no TSO. All right, but we'll talk about the TSO a little bit later on. So moving on, the spring showed low volume, which means that everything was clear. There was hardly any supply coming down anymore. There was no demand here, so this was just the smart money checking out the best prices it could get. Most of the short covering had happened on the climax, so this was the point now where they're preparing to sort of get long in the stock and just shake everybody out. So the volume is seen here is just really guys in the know, right? There's no one here. The public are largely not going to pick up on this stock. In fact, when I was looking at Innoviva, no one was looking at Innoviva. That's just it in a nutshell. No one cared. It's like, what the hell is that company? They're probably it's just gonna go sideways. So, but what you will learn if you're a stock trader is that these are the stocks that offer up value, right? And these are the guys I like and I look for, right? So going forward, we develop in a phase B, right? And as we go into phase B, notice that there's volumes very low in the stock, and that takes us into phase C. And then we have another secondary test, which is about $7.88. So as we push out of the trading range, we start creating what we call secondary tests. Now, there are a couple of these. So we got 1, 2, 3, 4. Generally, sort of, we expect around about between 4 and 6 STs within sort of phase B and phase C. That's generally by my count. Right, and then we develop into what we call the last points of support. So again, it's at these points that, again, I default to Elliott wave, that we tend to see a third wave start to emerge, right? So usually when we can see that step up movement, right, we tend to start visualizing that this market is going to form into some kind of a trend, right? So again, it's nice to kind of establish at this point that we could enter up into a very quick markup. So again, a great buying opportunity is normally at the what we call the last point of support, okay, or the LPS, right? Usually within the LPS, we should see a bit of demand, right? In this case, we're showing very low volume in the LPS, right? So it means that investors probably weren't very confident about this stock to kind of even join the composite man here. So everything that was going on here was largely composite, but there were slight spikes of demand, and I always watch out for these, and we can mark them out. So we can see a bit of overly excessive demand sitting somewhere about here, right? And if we look slightly inwards, we see another slight spike sitting over here. So we know that this is the LPS area because it is what I normally call an SOS, or a sign of strength. I always look out for that SOS, right? So just remember that, guys, SOS. I'm going to add that in here. Right, SOS. I always look out for an SOS in that phase C, because SOS is 9 out of 10 times are in a phase C. On the odd occasion, we get within a phase D, but phase D, we're normally above the creek, right? But I always look for my SOS very early on within the accumulation area in phase C. So we got that SOS, right, which popped on in 2010, 22nd of March, and this stock now, we know that the composite man, it was ready to move it. It was only a matter of time because he's already started to buy at what I would call slightly inefficient prices. And also the hedge funds, the other big guys in the know, are now looking at what the composite man is doing, and they're trying to capitalize on that. So this is like a very major thing for me, is the SOS. So I always look out for it. So you will see them across the board, okay, but that's my SOS. So this was the LPS within phase C, and then we popped above the creek and we started a major markup, and you could be forgiven to thinking that this thing was going to blast. But just remember, guys, markets are not linear, all right? So whilst we streamed away into what looked like a markup, it was part of a bigger play. So as you can see, this development now, which was visible, we did enter distribution at some point, right back into the accumulation area, but this was actually just a back under the creek, as larger traders now are now going to impose their will on this stock, and you're going to see how far this thing actually goes. So we come out of the creek briefly, right, which is always expected, and that allowed a lot of potential profit, because that stock, if you were buying it and you followed the instructions anywhere near the ST from $6 to $8 a share, eventually at the top side you cashed out at $21 a share. So it's a really good investment, right? And then we pulled back on the distribution into the creek again, and then we formed a bigger, or what I would like to call a reaccumulation point at that stage, right? So as we move in, we can see the LPS, right? So that was the wider last point of support, and look at the volume, right? So that's the justification right there. Look at how high this volume is, right? And that's because the larger traders who are now sapping up the demand are now available on the playing field, and they're buying at 10.98 a share, slightly more inefficient, but they're not honed in on the smaller frame. They're looking now at the big picture. So now they're buying here, and just look how this thing goes. So when immediately we get the LPS, it is also, this move down is what we call back under the creek, right? So we had an LPS and a back under the creek at exactly the same place, right? And then we push upwards. So now you can see us rise, right? And then we start forming. Now we're now firmly into phase E. We're now very much in the markup phase. So this is the very last LPS. There's hardly anything going on. There's no supply on the downward trajectory. And look at how that demand picks up as we go. So it's rise in demand all the way through. And that takes us to highs where distribution now kicks in, right? So this is like a longer term distribution of $34 a share, and that's why the big guys were going in here, because what you're looking at is from $10 a share to $30 a share. I mean, it's like 3 times your investment. So if you're buying if you had confidence in the stock to step in at the early days through the phase A, B, and C when the cause was really developing, yeah, it took you a few years to get your return, but once we stepped in, you were in the territory of supernormal profits, right? That's what we call supernormal profits. So guys who are familiar with economics will tell you it's about that. That's what we want. We want supernormal profits. So I'm buying here. My risk is incredibly low on this asset. I would not sell out this stock again, even if we were to break the spring, I would really reconsider selling that stock. But the truth of the matter is my loss on this investment will be relatively minimal in proportion to my gain. So that's kind of how I look a lot about investments. Is it's about maximizing, right? So I'm not a shy investor, right? So as you can see, this stock boiled away, and then we distributed back down in the accumulation zone, and the process restarted itself. Okay, so again, we can see that demand get in here. So that's the bigger traders now as we dropped back in again, and that was the reason why I was rebuying in Aviva a second time, because I can identify the climax. I can see the in this case we just got a secondary test. I can see the AR form, right, and that's my trading range, right? So this is just live and dynamic, right? So that's my trading range, right? And you can see all those tests, and you can see that point here where the demand comes in. So we know that this is pretty big, right? Because that was supposed to be an ST, and if you notice, we didn't get a spring, right? So unlike what happened here, there was no spring. In fact, we formed the AR, right, initially, and then we took off. So we have a few interim STs, but no spring, right? So, and then the market starts to mark up, right? So again, it's all about being flexible with your ideas and being a bit more dynamic, because we're back within the accumulation area of the past. I have to look at it. The markets are not linear. So this could be part of a much larger cyclical play. It could be part of a much wider, this could actually be an entire phase A. So this whole thing could be an AR on a much wider cycle, and this is just part of our ST, right? So this here would be an ST, and then that means that we can develop in here and then maybe push down again, and we might see a much bigger growth curve in this stock in the future. And this is how the S&P 500 grows over years. But then you get all these people, or sometimes I like to say the idiots, excuse my French, who would literally go out there and say that this market is going to collapse, and they start looking at, they are stellar cycles. They're cycles that are going to span years and decades, but we are in a world that desires growth at this point in time. So no matter what happens, some of these stocks are gonna move into oblivion, or they're gonna get acquired by different companies, but there is always gonna be value. Okay, we got to bear in mind that this could be part of a wider long-term play that we are not right now seeing. Markets are not linear. All right, good guys. So hopefully we enjoyed this section of the course that looks inside accumulation. In the next module, we'll look at inside distribution. But hopefully this has started to give you guys a very good picture, or a very good idea of what takes place in accumulation and how you should be getting in on these stocks. All right, hi guys. Welcome to this other module, which is going to be looking at distribution. So again, we're going to focus on the composite man, right? And I'm picking this particular example of distribution because it's a particularly difficult one, right? And you're going to see how the operation works inside distribution. Now, it's difficult because the trading range is not perfect, right? And for a number of reasons. If you're looking at this on a longer time frame, say on a weekly, markets are not linear, you won't be able to see any of this detail, right? So it requires a bit more thought. Now, the good news about using Wyckoff logic is that you don't have to act straight away. You will always be able to identify terminal upthrust and upthrust after distribution. Now, there is the possibility you might be in too early, but at the same time, you're going to have an opportunity to hold that, short that stock, or stay in a good short position while the stock has some time to cool. Just remember, when you deal with the stock market, patience is the key. And it doesn't matter if we're dealing with a commodity, patience will be the key. Or however, you'd find that commodities might not take as long to distribute, or currencies might not take as long to distribute. Stocks tend to take longer depending on the stock or what's going on in it. So I'm going to use a very difficult example, so this should cover all the bases, right? So first and foremost, we get a climax. Okay, so this was a very low volume climax. It would have been very, very difficult to identify, right? But you would have been able to identify it when we saw the AR, or the automatic reversal, which in turn during high volume. Now just remember, guys, climaxes are not always high volume climaxes. These days, the composite man is a lot smarter. He doesn't easily give away the climax. So obviously he's already out of the stock for based on various different technologies that now exist. It's a low volume climax, and then the market keeps going, and then you start seeing retail traders getting involved. Okay, so in this case we got an AR, or an automatic reversal. So for me the trading range was established and I can see my phase A. Now it doesn't matter if I'm wrong about this phase A, it just matters that I've identified some of the key things that says to me that this is possibly a phase A, considering this market has been in markup for quite a long time. If we go back historically, right, we can see that this has been a heavy markup and we can see all the demand at the bottom. So it's a reasonable argument to make, okay, a very reasonable argument to make that this is possibly distribution developing here. Now, what you would notice with this specific stock, which is Points International, another stock that I absolutely love, and I think it was quite sort of mid last year, I put out a big notice to keep an eye on this stock as a potential runner in the future, and Points International is doing quite well for where it was before, okay, but we'll come to that. We'll look at it now the way it stands. In any case, we got the climax, the AR, so I got my trading range, right? So now I just need to monitor this trading range. Now, one of the things that are different from accumulation and distribution, there's also a spring, but we tend to get multiple springs, right? And which is typical when an asset is overvalued or exhausted, right? So we get the AR, right? My trading range is established. We push up and we get our secondary test. Now it will be right if you thought that that was a terminal up thrust, okay? So that terminal up thrust tends to be that spring, right? So you might have thought, oh great, I got this 26.89. It's a terminal up thrust. I'm gonna pull the trigger. Now if you look at the setup, you can actually see that there was high volume. So if we actually, whoops, there we go. I need to make sure I've lined this up properly. All right, so if you actually look, we have low volume, right, at the top. So which was our first secondary test, and we could say that, oh, correct, that's the TUT. So I'm going to go short now, and then that's it. The volume up there tells me there isn't a great deal of supply, and then we push in the terminal up thrust, and if we look there again, there's hardly any volume. So you're still thinking the same thing, that, oh damn, why am I not seeing the volume? Now what was really interesting about this stock, if we look closer on the 18th of November 2013, you can see that the volume matched the higher volume that we initially saw in the AR, right? Which to me tells me that that was probably our climax right here. So that was probably our higher volume secondary test, but the stock ran away a little bit before cutting back. Right, so you would have been convinced, in my opinion, to go short of 26.95. But then we pushed in a TUT, right? And when we saw that extra step up, we then know that this is more like the TUT, but there's no volume there either, and we break back down again. And then finally, we have the up thrust after distribution. Now, look at the volume posted against this. There's absolutely no doubt in your mind that you've just seen an up thrust after distribution. If you're posting this much volume, which has been the highest for years, right, well, for that year anyway, 2014, you have no doubt in your mind that we are witnessing an up thrust after distribution. So it took a while. So even if you were short at 26.95, I mean, you only had to endure a certain amount of pain before this thing came back down again. And let's say you were short at 27.75. You know, you took that first TUT. Again, it wouldn't have been a bad idea. But if you had the patience, right, and let's say you misread everything, every single cue, and you got in here at the up thrust after distribution, you absolutely destroyed it. Right, so that's some of the stuff that we got to look out for, is that it's not, markets are not linear. You are going to see responses in higher frames, and that cyclical nature could bring a little confusion. But just keep your eye on the price. Look at where the climax is, and just anything above that is a benefit. Right, just give it some more range and some more time. Just make sure you're trading off a spring. Right, so even if you thought this was the spring, you know, sort of $26.95, $27 a share, not a big deal. Just know that we might not get further off the ground beyond that. But anyway, this share traded up to about $31 a share before eventually killing over for good. Right, so here we see some of the lower secondary tests and signs of weaknesses that are more or less evident in phase B. So just remember, phase B incorporates the terminal thrust, secondary tests, all within phase B. The up thrust after distribution is phase C. So if we see an up thrust after distribution, it is not going to be long before the stock collapses. So the phases are equally important that the markets go through, right? Because that's the cause, right? So phase C is the up thrust after distribution 9 out of 10 times. Right, once we're in phase D, we start to witness last point of supply. That's normally denoted LPSY. That's my bad. I put LPS. LPS is last point of support. So we normally denote that LPSY. Right, so I'm just going to change that as last points of supply. Right, so usually the last points of supply is similar to Elliott wave in this case. So we get obviously our wave 5, which is our upthrust after distribution. Right, we push back in to the trading range, and then we go back, we create a last point of supply, so very similar to our LPS. And usually sometimes you'll find a lot of supply sitting here, and then that helps push it down. But in this case, this was a very uncertain investor behavior, and then what we eventually got is a hell of a lot of supply back into the trading range. So there was a lack of confidence as to whether this thing is going to tank, but eventually once we came the ice, or broke the ice, that was pretty much it. So you can see that high volume there of supply, and then we had that phase E where we were back over the ice, and then we started trade down. So usually most people got involved in shorting this stock at the mid part of the distribution range at 21.51, and then the rest of the public would have got involved maybe in $18 a share. But either way, it's been still a reasonably good return for distribution. And if you look at the stock now, right, and this is one of the reasons why PointsCom came on my radar. And so let's go back, go forward in time. So just zoom out. Right, so we can actually see that that's a sign of strength right there, right? But I'm not going to plot this now, but you can actually see those points, and it's always nice to do a 1, 2, 3, 4, 5 count very quickly from the phase E. But you can see this was our PS, right? So now we're in a longer time frame. So if you put this in a week, it will look a lot clearer. But there you can see our PS, and you can see that point where we go in, and you would probably be assessing this a lot for the climax. Right, but that was our PS, right? So if this was our climax, so you'd be assessing the volume, it did look like a climax, and then we created what looks like an AR, right, a trading range, and then we dipped under. So you could easily regard this as your spring, right? And you can see there was a lot of activity around about the spring area, and then we started to develop. So it just depends on what time frame you're looking at and what you want to call your trading range. Again, some traders might have picked this up a little bit late, and they would disregard what's going on here and then refer to this as the climax and these as the tests, right? But from my perspective, this was the climax. This was the climax. This was the this was that point where we got so this is, in other words, this is the let's go back. So this is the PS, my bad, and this was the climax, and this was the AR. So the trading range got dictated from here to here. So it's not always simple. So sometimes you get a bit of a confusion. But if I lock this onto a weekly chart, for example, right, now you can actually get a clearer picture, right? So you can actually see at this point what was going on quite clearly. So, and then it starts to make a little bit more sense, right? So this looks like our AR when we look at it on this frame. This looks like our test, right, or our spring, right? And then we had another one here, but I would say this is the spring, so I would have disregarded this, and I would have put this climax, the spring, and then we go up, we test the trading range, and some people call this a TSO, right? So if we look at what's happened now, because of the phase we are at, I would say this is a TSO, right? So it's terminal shakeout, this was our spring, and this was our climax, so it puts us back. And if I count back, right, so good practice, just trying to establish a 5-wave count, 1, 2, 3, 4, 5. So we're absolutely right. It's the climax. So by going into the daily, markets are not linear, guys. By going into the daily, it restricted my view of it. But once I zoomed out into the weekly, I was able to kind of decipher what was going on here, which means that this here was a back under the creek, right? And that's why point PCOM for me was a great buy, right? So again, you can actually see that where all the demand was, that is exactly where you want to be purchasing, right? So just that point, because this is the LPS, and then obviously we want to be making a move, right? So again, this was a great asset, and I was talking about that to guys. So again, if you look at where that demand is happening, that's taking us back to 21st of August, so 2017. So I was talking a lot about PCOM, right? So for guys who follow me, would know that I was discussing a lot about PCOM, right? So that's PCOM in the future, guys. So obviously we were talking here about distribution, so not going to get carried away, but that was our distribution point, right? So just you guys have a very good example of some difficult forms of distribution that we're going to witness, but as long as we can identify the phases we're in the market, then it becomes a very advantageous place to get involved in. Right, so again, that sort of concludes everything you need to know on distribution. Once we come into the next volume, we'll look a little bit more closely at some of the more common examples that we can work with, and we are also going to look at checking safety of your position, right? How would we actually execute into this? So a lot more to come, guys. Any questions, don't hesitate to send them to me and I'll be glad to answer. I know it's a very broad topic. I hope you enjoyed it so far, but any questions, just let me know. So welcome to this module that is actually going to cover the best way to check your position. Okay, so just before we enter a position, how do we go about determining what's the best place to get in, right? So a lot of you guys may have seen a lot of maybe courses on Wyckoff, but no one tells you when to buy, right? So I've gone through the trouble of actually selecting one of my own stocks from my portfolio, and that's going to be my buy this year. Okay, so I'm not gonna mince this, right? This is my stock and I love this guy, and I've been watching Anglo Gold and Ashanti for like a long time. And for those of you guys who are not familiar with miners, I've been crunching their accounts, I've been looking at them. That's a completely different part of stock investing, okay? And I probably have to do a whole separate course for this, but just remember, guys, you don't have to even go through all that trouble. I have certain criteria that I want my stocks to meet in my portfolio that takes me to their accounts. And I want to know about any acquisitions because that could mean money. And just to give you guys an example, I bought a company, I think it was, last year? I lose track of time. It was either last year or 2016. Anyway, I bought a company in China called Trina Solar. And Trina Solar was pretty much in its accumulation phase. And something really interesting happened because Trina Solar got bought out by itself, basically. They bought back their shares and they offered a premium. So I was invested in Trina Solar at the price of just, I think, roughly about $2 a share. Trina Solar offered me, I think, about $4.50 a share. Yeah, roughly around that anyway, on an acquisition. Right, so I got paid out for my entire share stock that I had, my entire share stash that I had with Trina Solar. So I do stuff like that, okay? And the reason being is that I knew that Trina Solar was probably going to make a play because I read their 10K report, and I realized that from their 10K report that they were going to make a play on the company, right? Because they were saying that there is the possibility we might want to buy back our shares. Because the direction of the company is really good and we probably don't want to be public anymore. Amazing, right? But anyway, I read that in the 10K report and I thought, great company to hold, and the 10K reports can reveal a great deal, right? So that's why I do it. But technically, the information was already there, but sometimes you have to be honest about skill set. And I thought that maybe I cannot deduce that kind of information by investor volume behavior on the stock, right? But I can see it in the 10K report and I can link that to any investor behavior. So Ashanti Gold is one, Anglo Ashanti is one of those. They got some mines in Mali, and Mali is a very stable country because the government knows what to do when foreign companies come in to mine their gold, right? They get like a 10% stake in those companies, right? So this, and they're pulling up a lot, right? It's a great company. And yeah, they're on my radar. Anyway, I'm not going to talk too much about Ashanti Gold, Anglo Gold Ashanti, because I'm not here to tout a stock. Right? I'm here to teach you guys about Wyckoff. Right? So we're gonna move away from that subject, okay? And guys, you know, trading is risky. Don't invest in this if you don't believe in yourself, okay? Don't do it because I'm saying Anglo Gold is a great company. I think it's a great company, and I'm going to do some analysis here, which will be very convincing, right? But don't go out and buy it because I said so, right? So just as a little disclaimer here, stock market trading is risky. You could lose all your money, your house, your kids, your wife, everything. Don't do it, right? That was a joke, right? But the truth of the matter is that, guys, just be very careful when you deal with investments. Try and build your own ideas, right? So all this stuff I'm telling you is to arm you guys so you can go out there and build your own ideas. All right, so let's move a little bit forward. Climax. Okay, so this is the whole point. If I wanted to get involved in Ashanti right now, so if you notice, I've got some arrows here. That's because I haven't yet bought this stock. Okay, I am actually contemplating doing it, and I'm looking to buy it. I'm of the belief that it can trade into $7 a share easy, and most likely we could be looking at a test or a spring at around about $4, right? But I'm not optimistic for that. What I am optimistic about is that there is a very good potential for this guy to rally out of these lows and trade up, right? And that's what I'm looking at. So on the interim, remember, markets are not linear, they're cyclical. So on the interim, it's possible that we're going to create more secondary tests, because we're now entering in what I believe we're now in a phase B. And if we're in a phase B, this is a monthly chart, so this could go on forever, right? So I'm assuming that during the phase B, we should find ourselves around about $20 a share, right? And this should coincide with a lot, right? And we should see impacts of this in other markets too, right? So that's some cross-market analysis that you guys will do with experience, right? So if I was going to buy this stock, right? So this is all about checking your position, right? So if I were to get long, right, and we will do this with a currency, we'll do this with anything. So if I was to get long, okay, let me use a different. Right, so let's say I was to get long at my preferred price of $7 a share, right? So just mid arrow here, right? Now, where would I look to manage my risk? Right now, I can see prior lows, and this is what a lot of people get wrong, is I can see where we are in reference to prior accumulation zones. So I want to make sure that I'm clearing my investment to roughly about $1.61, and that's my risk, right? So if this thing were to push lower, then I would assume that if we're trading on the $1.61, then I really got to consider that I made a poor investment, okay? And I might have to get out of this asset because it's now in a new reaccumulation point. Or, truth be told, I could hold this stock. With the stock market, it's non-margin trading, okay? So you can hold it. You don't need to cash out, right? The truth of the matter is that you might just have to buy more at a slightly lower price and just accept that you paid a poor price earlier on. So that's the dilemma sometimes you have with stocks. And the company may well get acquired, so you might get offered a premium, but you might still lose on that investment, okay? So just things to bear in mind. But if I'm right on this stock, right, and I can get that achievement, then I'm looking to probably cash out in the future for about $20 a share. That's relatively a good investment if you think of it more from a risk to reward point of view, okay? So just so we have it. So this is a very simple way of dealing with risk and loss. It's actually, there's nothing complicated. When we deal with margin trading, so let's pretend this is like dollar yen, GB USD, euro GBP. Let's imagine this is the class of Forex, right? So my stop loss would probably go exactly at $1.61, which means that I will be exited out of that trade. If it hits $1.61, I don't really have a choice. It's margined here, and I'm probably going to lose my money, right? Now, however, if I'm right and it goes up, then of course I'll be cashing out at $20.60. So again, this would be your stop loss, and that's how you manage it. Now, as we start to build up, right, let's say as we get into, in a margin trade, as we get into $16 a share. Now, let's say I was holding 5,000 shares of this guy, and I decided to cash out 2,500 at $16 a share. That would be a really good trade, right? Because I'm selling 2,500 at that price, and I'll hold the rest. Now, if I was in Forex, I would, instead of cash out, that's an option depending on how many lots I'm holding, but I would cash out and I would say, well, I'm going to break even the trade. So basically roll my stop loss to just a little bit, let's say $8 a share, right? So that's my stop loss. So if we were to pull back from about 16 back to 8, then I want to exit that trade with a no loss situation, right? And that's how we manage it when we're dealing with margin position. But in this case, we're not dealing with margined positions. We are just dealing with buying the physical stock. So in this case, I want to keep my options open, and I would say, well, reasonably, it becomes a bad investment at $1.61, but in reality, I can still hold it. Or it goes up, in which case it becomes a great investment, right? But this is definitely our phase B. So position in it is really crucial when we deal with this going forward, and that's how we manage those positions. Now, on the flip side of the fence, you could potentially also look at, say, well, let's assume we get the spring, right? In which case, if we get the spring, I would look to buy, the moment I see the spring and some strength out of the spring, I look to buy about maybe $6.50 a share. That would be a great investment as well. So I maximize. So right now, I'm waiting for this stock to drop slightly lower in order for me to get involved. Now, what's the crucial bits here? We got the climax. So this is a typical low volume climax, okay? So even though the volume's a bit spiky down here, relative, the volume's quite low. It's relative to, and that's the other thing about volume. Look at it relative to what the volume's been trading in the stock, right? So for now on the monthly, it's a bit low, but there's definitely some climaxing going on there. and then we pushed the AR actually. And if you look at the AR actually occurred over from about sort of 1st of July 2015, and that AR ended 1st of August 2016. So it was a straight run up from $6 a share to $22 a share on the AR. Okay, so this is crucial, and you find a lot of traders actually look at the market in this context of you know, trading it within swings. All right, so now if we hit the lows, I'm expecting more STs, right? We may even break the barrier of the trading range, right? And if I hold it for even longer, I can accumulate this position, very similar to the way the composite man does, right? So you can kind of create a bit of what's the word? A bit of an idea, right? So I can then start exploring the concept, okay, that we might hit down and we might start seeing LPSs at this point, right? So I'll be accumulating slightly higher as we go, right? So I can start visualizing potential moves, right? And then maybe a test of that upper side of the creek. And then I can see more LPSs, right? And then eventually I'll start a big markup, which might take me even a $40 a share outside of the trading range. And this could be like in 2025, right? Or 2022. So this is not like something that's going to happen overnight. But if I wanted to accumulate this position, I can cash out my stocks at different points along the way, and then I can move in for the big buy for the last run of the decade or that kind of stuff. The next credit crisis on the horizon, and I will be riding that train all the way to about $40 a share, in which case I sell out and I start the new distribution and cause the biggest crash of all time. And, you know, just like you saw in, you know, Jesse Livermore being blamed for the 1929 crash. So, but you're never going to be blamed for that because we just don't have enough money to cause that kind of a problem. But there will be investors who people will be looking at the point where we make that decline. So you can start to build a roadmap with some of the investments that you're making and where you expect them to be based on how you're visualizing them on what cycle, and being always mindful that the markets are not linear. There will always be another cycle in operation. So the smaller your cycle, the more aware you have to be of other cycles in operation, right? And yeah, so that gives us an example of obviously how we manage more or less a live type position using a real-time stock. Okay, so that's just about a bit of safety check-in, right? And very lastly, don't forget your 5-wave check. Okay, I mentioned this earlier on. Really important, right? If I can identify 5 waves anywhere, right, then there's a good chance that I am witnessing something quite interesting, right? So that 5-wave could run into a climax. That 5-wave can run into a spring, right? But as long as I can see that, the climax tends to be at the end of a third, right? Sometimes with waves, and that's what people get wrong, is that we might end up with this scenario, okay? So this could be it, right? So this here could be, this could be the spring we're running into, right? This is the climax, and if that's the case, that's the end of our third. So there are a lot of things that we can use, but I want to be able to establish a 5-wave count just to give me like a bit of a safety check, okay? Just keep me aware of where I am relative to certain asset behavior. All right, so hopefully that helps, guys. Any questions, let me know, and see you on the final module of this program, and hopefully you've enjoyed it. All right, guys, so this is the final part of the program, and I hope you guys have enjoyed it so far. So this is the point where I'm just going to sort of go over some of the things we do, again using live examples. So just very typically, so you come into the stock for the first time and you want to analyze it and you want to make a play. First things first, we are going to determine where we are in the cycle. Can we identify a 5-wave count? Now we kind of can, so that's step 1. Okay, so now we hit a climax. We can identify the climax point and high volume, and that should take us into an AR. So we're going to define that trading range. So this is an opportunity to see this all from step 1, and with this stock is Facebook. Right, so and by the way, I've already done this trade. So this is a trade that I did, and this is a trade that I actually advised one of my clients into. And when everyone was panicking about the story, the Facebook story with Cambridge Analytica, that's it. I was saying that this is the greatest point right now to start considering buying Facebook, and I'm sure a lot of people agree with me, and probably there are a lot of guys out there who actually made the same decision. So that's the first thing I want to identify. So I find my climax. So very quickly, I'm going to type in here climax. And I've also identified my high volume, right? So you want to do this, right? It's good practice. It looks like hard work, but if you're stock investing, it's really good practice to get your head around this. So just so you can do the relevant safety checks as you go along, right? So so now I know where my AR is, all right? So that's my automatic. This is actually a 1 hour chart of Facebook, by the way. So this would have been a really great call. So that's my AR. So I got my automatic reversal. Now it's very possible that you're going to see the AR and then you want to buy on the test, right? So I've actually got an ST right here. So that's my secondary test, right? And that takes us in a phase B. So if you notice, there was no spring this time in Facebook. Remember, markets are not linear, they're cyclical, so there's always something going on a larger frame. So this could actually be an AR on a much bigger frame, right? So we just have to bear that in mind. But for now, it looks like accumulation on this frame, right? So that's my ST. Right now, most importantly, at that ST point, I can see also that there's high volume, which tells me that that was a significant amount of demand down there as well. So it was not supply because of the way it's located. So that's not something that we would even debate. And I've got my high volume here. So I've got two forms here of high volume, and that's my ST. So at this point, right now, if you're not smart enough or you're slower and you don't pick up on the fact that this is the AR and you're on your return to 150 a share, you should be a buyer, then no problem at all. So we register in an ST, right? Judging from what happened with Facebook, there would have been a slightly longer accumulation. So we had an ST, which is great, and then we powered back down again. So now what I would have been expecting is that we might end up pushing a TSO, right, which would be just at 148. But either way, it is a good buy anywhere back on a retest of 150 with those lows. So I would actually want to buy the lows exactly where the market bounced off at that point, right? So this would have been a great buyer for me. So I just set a limit order there and say, well, look, I'm happy to take anywhere at that range. I'm not greedy, so I wouldn't look out for the TSO, right? I can see there's an ST here with high demand, so we might not be able to push it. And as we do these final STs, we can actually see that the volume's depleted, which tells me that the market is now ready to move, right? So that we should be in a different phase, right? So let's try and define these phases. So if you remember, the AR and the climax and the AR consist of phase A, right? So it doesn't matter where this lands. It doesn't have to be 100% accurate. It's just to give you like a guide and idea. So that's phase A. Right, and in phase B, obviously post in the upside secondary test and the sort of lower end STs, right? So that's my phase B, right? Right, so I'm down here somewhere with phase B, right? So I should have been buying in phase B, right? But let's say I wasn't, so this is phase C, right? So phase C is quite small, and it will normally, we'll find the LPSs there, and I should start seeing my sign of strength, okay, in phase C. Right, so that's phase C. Now phase D will be rather brief because what I'm now expecting is we're now in phase D, right? So we should look, whoops, actually. So what we're going to do is, just give you an example. I'm expecting we are going to do this, and I should get a back under the creek situation, right? I might not, but that tells me stocks that I really don't want to get into and ones that I do, right? And then we should come out of there. And then that should move us into phase E. So we got phase A, phase B, phase C. So this is a well-mature move now. So we're very late on this, and this is how you know you're late. Because at this point here, in phase C, we already started to show signs of LPS, right? So last points of support, right? LPS. Right, now, the thing to note here is I'm looking for my sign of strength, and I can see that here, right there. So that's my SOS, and that came in D, phase D, right? So, oh, there we go. So that's phase D. Now, to be honest, some traders may well extend their phase C, and there's nothing wrong with doing that. Is if you encompassed all of this as a phase C and then looked for your phase D here. And that's not an issue. Remember, you know, this, you're not going to get this like, there is no prescribed 100% I'm right sort of situation, okay? It's just what it is. So our phase D should put us here, right? So the next phase we should be in phase D, right? So we got our phase C, we're phase D now, where we should be looking, our last point of entry would be 160, right? And we don't know where this is going to distribute. So from 160, my estimation is we should get about 173. Thereabouts should be rather comfortable, right? But that's where we expect ourselves to be as we develop, right? So just and this will be the final phase. So we got A, B, C, D, and phase E is the final phase, which is actually the markup. Okay, so when we're in phase E, the move is gone. It's away from you at this point, right? You can get in on phase E, but it is away from you, right? So that will be our phase E, and it should encompass the markup. So that's my opinion on Facebook, right? So this is a live one, and if you look at what's going on here now, you can see there's actually more signs of strength. However, it's on the high side, so I'm guessing that the stock will pull back into the creek, right? So we got more SOSs, right, as we develop. And this is how, and so if we look at the volume trajectory, it is one of a rising one, right? So this is how we do our analysis, all right? And this is how we identify the phases, and this is how we build into them, right? So going forward now, this could mark up quite heavily, right? So it could even mark up as high as $180 a share before distributing again, and it could also be part of a bigger play, right? So just again, markets are not linear, so you are going to get a cyclical effect. So it could be part of a bigger play, wherein, like I said, it could have been an AR, and then we could be back down again, and then retesting some lows. Even though we're distributing, we're now reaccumulating again, and then we can start a much major markup, which will then take us to maybe over $200 highs, okay? But we don't know that yet. The bottom line is that we're working within our horizon based on what we're witnessing, which deals with climax, etc., etc. And just be aware, markets are not linear. They are cyclical in nature, which means that other traders are acting out simultaneously, and they will create a cycle effect. So there ends the course, guys.